Is it time to buy or sell gold? First off, read this disclaimer carefully. Okay, so gold has been in a very big bull market, but there's been some pullback. So let's like take the pulse on gold. Okay, so we can find gold under here, Heartbeat. I have it as a part of the Doom and Gloom portfolio. This ETF in particular, which is the SGOL ETF. So if we go here and first look at the seasonality, you can see that, you know, September is one of the weakest months for this ETF, but October is, you know, decent. 55% of the time it closes higher than it opened. Let's look at it against the S&P 500, the ultimate benchmark. Yeah, there's been some historical underperformance during this period. Let's look at it against the GLD just for comparison. GLD is of course the most popular gold ETF. Quite a mixed message. But bear in mind that we only have 12 years here. Okay, we ideally want to have 20 years to draw a conclusion. What we have seen though is that there's been this monstrous rounding bottom pattern here for gold. We've broken out above the prior highs from 2011, and you can see here throughout this rounding bottom we had, you know, some meaningful corrections. So here is where the bulls start to gain leverage, but even after the bulls had leverage, like this correction, all of a sudden we go down 14%. Here we have a pullback of, you know, around 14%. Maybe there's a bit of a theme emerging. Let's actually measure this correction as well. A bit deeper, 18-ish%. But yeah, when there are pullbacks in gold, let's just also measure this one. From this high here, the intra-week high to the low, yeah, 15-ish%. There seems to be like, you know, that's around the territory gold likes to pull back. When there is a correction, and if we look at the most recent correction here from the high, if we nail the high like that, yeah, so minus 9%. If we go down 14-ish% and even 15, maybe even 18, who knows, there could be a bit more downside. The thing is that when you have a bull market, it is completely normal and to be expected to have some corrections. This bull rally here was, you know, quite excessive. You see that throughout here. You see, especially if you look at the purple 20-week moving average, it is thrown around a bit. And that is very indicative of, you know, a market that is moving a bit in waves, up and down. Here, it's been positive throughout, you know, it's been very bullish. But maybe it was a bit too much too far. What I think is going to happen is another technical pattern. So we have the rounding bottom, but there's also this pattern called a cup and handle pattern. So let's paint the cup and handle. So a cup and handle would be like this. So here we have the cup, and here would be the handle. So that's a cup and handle pattern. Hence, even if we do correct a bit more and form a bit of a handle, that's not a problem. It still is a very clear new bull market, and it is actually very healthy to have these pullbacks, because this was becoming basically a bubble, and we do not want a bubble. We want a reasonable bull market where there's where you have investors with a level head. Up here, people were getting very euphoric, and you had talk about, you know, 20,000 gold, you know, 50,000 gold, and it became pretty ridiculous. And that does damage long term. Hence, even though I do understand if you are a gold bull, you do find the recent pullback a bit annoying. You didn't want to see it because, you know, you lost a bit, but long term, in the big picture, this is actually something you should be happy about. This is actually good news. You want this. You want to have a market that is balanced. An unbalanced market, it never ends well. Okay. If you look at the RSI, we were certainly overbought before the pullback. If you look here at historically overbought levels, it has usually been something you can trade up, except for the strongest phase of a bull market. Like here, we were overbought for consecutive weeks here as well. Something that is very nice to see here is that the accumulation distribution line here, which is showing us whether there's an influx of buyers or sellers, and you can see that there's a clear increase here of buyers. That's great. That corroborates this breakout. There's a 69% positive correlation with the S&P 500 long term. Let's look at the daily data points here. So here you can see a 71% positive correlation. Let's actually just look here at it again. Let's look at the gold, the GLD. We saw something quite similar. Let's get it back. That. Okay. Very strong rally. We do have some pullbacks every now and then, but we were quite far away from some of the longer term moving averages, like the 200-day moving average and the 100-day moving average. If we go further back, you can see that it was we frequently tested these moving averages. And if we look at some other bull markets, like we have with the S&P 500 and I mean, you name them. I mean, there's a bunch of them. Let's actually just look at it, just so you can sort of like get the picture that this is not a problem. So this is the total world stock market ETF, okay? So let's go back here. You see that when we go back to 2012 here, the 200-day moving average, it was tested very frequently, even slip a bit below it. But it's completely normal to test it, it's not a problem. Let's look at the Nasdaq. It's certainly a very strong market index. Here, you know, 2013, we test the 200-day moving average in red throughout. This was a clear bull market, so it's not a problem. Hence, when we look at SGOL here, you know, it's very good to test it. Hence, even if we were to go down to the 200-day, I don't think it's a problem. So let's explore this ETF a bit further. So this is the Aberdeen Standard Physical Gold Shares ETF. Okay. So the fund offers so like the thing about investing in gold is that the only real gold is, you know, physical. That's true gold, you know, the real deal. When you invest in ETFs and stuff like that, it's something different. You are not, you know, outside of the financial system. Even though you might think you are not. This is one of the reasons why we have seen in times of market turmoil both the paper gold go down and, you know, the stock markets simultaneously. Though in the physical gold spot market you can see a disconnect, you know, where there's actually an influx of buyers. There's a lot of demand and a limited supply. So that's something to just be aware of. The interesting thing about SGOL is that it tries to sort of like strike a bit of a middle ground. So SGOL is designed to track the spot price of gold bullion by holding gold bars in a secure vault in Switzerland that is audited twice a year. The company also posts the serial numbers of the bars, giving investors further security over the status of their investment. While SGOL isn't the most liquid way to gain exposure to gold, it could be a solid choice for investors seeking greater peace of mind regarding their physical metals investment. So that's the key distinction here with SGOL. It kind of tries to be a bit more, well, it is holding the actual metal. But the only way to really have exposure to gold in a real way, in the way that's been done for thousands of years and has worked for thousands of years, is to actually get the physical metal. Whatever you do, of course, don't fight the trend, and may the trend be with you.